This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Houses divided, stocks sink, short-term yields spike, and a credit rating agency warns it could downgrade U.S. debt. All this as the House and Senate collide over competing proposals to reopen the government and avoid default.
Tech tidal wave. Intel beats, Yahoo issues poor guidance, and this is just the start. What are the key things you should watch as the biggest names in technology begin releasing their quarterly report cards?
All that and more tonight on Nightly Business Report for Tuesday, October 15th.
Good evening, everyone. High drama in D.C., and the fallout is already being felt. The House of Representatives says it has a new plan to open the government and extend the country's debt limit. The Senate says it'll wait and see. And while all this is going on, ratings agency Fitch put the United States AAA credit rating on negative watch. What that means is the sterling rating is under review for a possible downgrade. John Harwood joins us now from Washington with the latest on the negotiations in Congress. So, John, where do things stand right now? What a day.
It's a crazy day. We thought we had a a Republican-Democratic agreement within the Senate that was going to become the basis for the final solution, pass the Senate, go to the House would take it. But the House caucus had a meeting this morning. Hardliners told John Boehner they wanted to put a different plan on the floor. They've come up with one. They plan to vote on it later tonight, but it is not at all clear that that's going to pass. Some of the outside organizations representing the hardline conservatives are urging no votes. And if that collapses, then we're back to Reid and McConnell, and we'll see whether they can have a deal and move it through in time to avoid default.
What are the elements of the sort of embryonic House plan?
The House plan would extend government funding, reopen the government immediately, extend funding through December 15th. It would raise the debt limit to February 7th. That's the position that was in the Reid-McConnell compromise. But it would also have some provisions that Democrats could not accept. It would bar the Treasury Secretary from using what we call extraordinary measures to extend the debt ceiling by juggling accounts, essentially, when the Congress has not raised the debt limit. This is something that every Treasury Secretary does, though there's no way the White House could accept that provision. It would also strip members of Congress, members of the cabinet, and their staffs of the employer contribution to their health benefits. This is an attempt to embarrass Democrats by saying you would be protecting special subsidies for staffers and members of Congress. But actually, the staffers and members of Congress would be the only people under Obamacare who would be forced to do without those subsidies. And so both of those are seen as poison pills by Democrats. And Reid and McConnell still have to come out with their plan, and we'll see if they can pass it through the Senate.
All right, John Harwood, thank you very much. We will wait and see whether there's a vote tonight or not. Well, on Wall Street, meantime, traders began the session with a wait-and-see approach to the talks in Washington. But optimism faded and quickly, and stocks plunged after Senate leaders suspended their negotiations to see what House Republicans would come up with. The losses were steep, swift, and across the board, with all 10 S&P sectors ending the day lower. The Dow fell 133 points, ending 4 consecutive days of gains. The Nasdaq was down 21. S&P lost 12. And while stocks slid, rates on short-term Treasury bills rose. And how? The Treasury's weekly auction of 3- and 6-month bills was not well received, with investors increasingly worried about the prospect of a missed payment. Look at that spike.
For more on the impact of that crisis in Washington, let's turn now to Roger Altman. He's the chairman and CEO of Evercore Partners, and he served as Deputy Secretary of the U.S. Treasury in the Clinton administration. Roger, great to have you back on the program.
Hi, Susie.
Let me begin by asking you about that Fitch news. You know, people have been worried for a while now about a downgrade on the U.S. credit rating, and now there seems to be a whiff of it. If that happens, how much damage does this do to the U.S. Credit reputation, and just how serious is all this?
Well, it is very serious, although if you look at what the stock market did today, which was a slight decline, really, it's not yet signaling great alarm. I don't think the market is yet convinced that a real default, meaning missing an interest payment or missing a principal payment, is really likely. Now, the Fitch announcement is a warning. It's not a surprising warning, because if we actually did miss an interest payment or miss a principal payment, they would really have no choice but to downgrade the U.S. Because under their charters, a default requires a downgrade. And Moody's, which also maintains a AAA rating on U.S. debt, United States of America debt, likely would be forced to do the same thing. But that's a symptom. It's not a cause, because if we actually missed an interest or principal payment and we really did default, not in some tiny sense, but in a real economic sense, the impacts would be really quite devastating. Every single American, every single organization which borrows money, a mortgage, a consumer loan, any other type of borrowing, would pay more, and pay more for a very long time as compared to what they would have paid if we didn't suffer this fate.
Let me broaden, Mr. Altman, out the discussion just a little bit. You're a businessman. If the United States government was a business, could you do business with it as it currently functions?
I think the answer to that is yes, actually, because corporations, as we all know, suffer financial emergencies, are often on the edge of insolvency, sometimes actually are reorganized under Chapter 11 all the time. Look at General Motors, for example, and Chrysler, which in 2009 both went through the Chapter 11 bankruptcy process, and today are both thriving. So obviously everybody who they need to do business with is happy to do business with them. So because the underlying credit, meaning the economic strength of the United States and the strength of taxpayer payments every year in the form of taxes, is actually undiminished. There's nothing about the events in Washington that are diminishing that. I think from a business person's point of view, the answer to your question is yes. But there are all kinds of institutions around the world who would shy away from buying Treasury securities, Treasury bills, Treasury notes, Treasury bonds for quite some time if, in fact, we defaulted, because many of them are prohibited, for example, from buying securities from anyone who's in default or has been in default for a period of a year or two or three. And so there's no question about the interest rate impacts of this possible fate should we suffer it, even though I think a business person would say, well, it's still a strong credit and we can do business with them.
All right. Roger, some interesting thoughts and issues that are not going away just yet. Maybe we'll circle back to you at some point. Thank you so much for tonight.
My pleasure.
Roger Altman, Chairman and CEO of Evercore Partners.
Well, even as negotiations continue in Washington to raise the debt limit, two major financial institutions are preparing for a possible default on government obligations. According to the Wall Street Journal, Citigroup and State Street Corp have been exploring ways to impose limits on the use of short-term Treasury bills, ones that will come due in the next few weeks, as collateral for loans or to facilitate other bank transactions.
Meanwhile, the chief executive at Walmart says the government shutdown is weighing on the minds of his customers, and he called the global economy unpredictable. But at the annual meeting with investors and analysts today, CEO Mike Duke also said, quote, "No matter what environment we are in, Walmart will win."
And another sector lying right in the path of the debt crisis is commercial real estate. Construction and sales have been surging, but that could change if lawmakers and the president don't come to a deal. In fact, some say damage has already been done. Diana Olick has more.
In cities across America, the scene is similar. Bulldozers and cranes coming back to life post-recession. The improving economy is fueling commercial construction as demand for offices, retail space, and multifamily apartments rises from the ashes.
There's a lot of momentum in commercial real estate. There's a lot of property sales. Activity is much higher than it was a year ago, certainly than it was 2 years ago.
Commercial property sales volume is on track to surpass $300 billion this year. That's up 380% from the low in 2009. Sales spiked in the final quarter of last year on speculation of higher tax rates. Imagine what would happen in the reverse if a debt default caused a spike in interest rates.
Commercial real estate is very interest rate sensitive and credit dependent and long term. Those are not good formulas if you have a high interest rate environment or an environment in which credit is volatile.
Commercial real estate is a highly leveraged business, depending on big banks and investors in commercial mortgage-backed securities. Banks have been very leery of real estate risk, but in the second quarter of this year, there was a net increase in lending on construction projects for the first time since the financial crisis. At Maryland-based Walker & Dunlop, a commercial real estate finance company, the view is positive for the long term, but uncertainty is weighing on both borrowers and investors.
The most discouraging thing that we're seeing right now is that this Congress is going to go through yet another crisis and probably end up kicking the can down the road, but not even as far as many people would like to see it get kicked.
While interest rates haven't moved much during the run-up to the debt deadline, just the anticipation of it has hurt investor confidence. Even if the deal ends up being a punt, that is, delaying any decision until early next year, commercial real estate financing will still take a hit.
Any of these disruptions that imply more risk, that make investors worried about what's happening with the bond market, that can push interest rates higher, not because the Fed is stepping away, but because there's fundamentally more risk in the market. Those are things that really hurt commercial real estate.
And may already have. Diana Olick, Nightly Business Report, Washington.
Still ahead, two big tech names out with late-day earnings, but there's one thing in each report that investors need to know. That's coming up next. But first, how the international markets performed today.
Pair of closely watched earnings after the closing bell this evening. First up, Dow component and tech bellwether Intel, which beat Wall Street estimates. The chipmaker earned profits of just about $3 billion, pulling in 58 cents a share compared with forecasts of 53 cents a share. Revenue right in line with expectations. Seema Modi has been looking through the numbers. Seema, welcome. What is the most important thing investors should take away from Intel's numbers?
Tyler, the takeaway here is that Intel was able to beat Street expectations and deliver solid earnings by primarily controlling costs during what is a very weak PC environment. So cost controlling, finding a way to maintain expenses, that's what has led to this expansion in gross margins.
All right, Seema, don't go away. We also heard from Yahoo after the market closed. The internet company earned 34 cents a share. That beat estimates by a penny, but revenue came in at just over $1 billion. That's down 5% compared to a year ago. So, Seema, what's the big takeaway on Yahoo's quarterly report?
Susie, the big takeaway here for Yahoo is that its user base continues to grow with more than 800 million monthly users on Yahoo, which is up 20% over the past 15 months. Yahoo CEO Marissa Mayer says this is a meaningful increase in user engagement and traffic. The question now is, can the company find a way to fully monetize this audience? Display and search ad revenue did come in lower year over year.
Seema Modi, thank you very much. And joining us now to talk more about other tech earnings is David Garrity, a principal at GVA Research. David, welcome. Good to have you with us. Very quickly, give me A, B, C, D, E, F grades for Yahoo and Intel, and then I want to pivot you to Google.
Intel comes away with a B grade, actually maybe a B plus, to the extent that they're sort of navigating this weak PC environment. If we look at Yahoo, we have to give them probably an A minus to the extent that their audience is starting to grow, and the real challenge now for Marissa Mayer, the CEO, is how to monetize this larger audience.
All right, let's look forward to Google. What do you expect there? I think it comes out on the 17th.
Yes, Google out after the close on Thursday. We're looking for some weakness as far as revenue growth is concerned. They've been doing some things to improve their search quality, which may have slowed activity in the third quarter. But we think that investors should look forward to the strong year-end holiday shopping season, which is typically in the fourth quarter where the company gets their best results.
And then we have Microsoft coming out next week. Tell us what you're expecting there. And this has been a really volatile year for Microsoft stock. Is it a buy at 34?
At 34, we think that Microsoft is still very attractive. There are a number of things that actually work in Microsoft's favor fundamentally. First and foremost, the growth in terms of cloud computing. Microsoft is coming in as a very strong contender in that area, very strong reception for their products, Azure and Office 365. And if we look at what's also going on in terms of Microsoft from a governance standpoint, they are going to be bringing in a new CEO, and when the new CEO comes in, there will probably be some changes made which may actually create value for shareholders. So we think Microsoft at these levels levels, continues to be an attractive stock. May not beat the numbers when they come out with the results on the 25th, but we think overall still a good name.
Let me dig a little bit deeper on Microsoft there, their relationship with Nokia, and I think of Google with Motorola Mobility. That acquisition has not exactly paid off. Mobility at Google has not really worked for them. What do you think is going to happen with Microsoft and their aspirations in the handset market?
Well, you have to look at the reasons why the companies are making the acquisitions. Yes, and they did get into the handset business, both at Google and obviously here at Microsoft with acquiring Nokia. But there was also acquired a fairly substantial portfolio of intellectual property or patents, which both of them are using to grow their base business. And from the standpoint of looking at Microsoft, they do have a devices and services strategy. They do need to be putting their product more in the hands of consumers, especially as consumers are starting to move towards mobile forms of computing, smartphones and tablets. Now, granted, Nokia not necessarily a powerful name as far as smartphones are concerned, but one would argue that the combination of a very strong brand such as Nokia globally, if we look into the developing markets, and given Microsoft's technology innovation, could lead to some very interesting upside over the next 3 to 5 years.
All right, we can't talk about tech without bringing up Apple. I know you've been recommending it for quite a while now. The stock crossed over the $500 mark briefly today. What do you think of Apple at this point, and what do you think about the stock as well?
I think Apple at this point, you do have the new iPad that's going to be coming out. Introduction, I think, is slated for the 22nd of October. There are invitations that have gone out for that event, so I think it's tradable here ahead of that event, also ahead of the result of their earnings that are going to be coming out shortly after that launch. At $500 a share, Apple certainly, one of the least expensive stocks among the tech sector, and also from the standpoint of one looks at their balance sheet, one company that's certainly able to continue to reward shareholders not only in terms of dividend increases, but may also possibly consider increasing their buyback as well. And we do have activist investor Carl Icahn, who is talking with management and certainly finding support from other institutional investors in this respect.
All right, David. Well, let me ask you one final quick question. We've talked about a lot of companies here, but is there one company that we didn't ask you about that you wished we had?
Well, certainly the Twitter IPO, I think, is going to be very important in terms of what it has to say about overall demand for the tech sector names as investable themes. Certainly, so we're going to have the roadshow starting for that transaction on the 25th of October. Probably have a pricing on the 15th of November ahead of Thanksgiving. There are some ways to play the Twitter IPO. There's a company, GSV Capital. About 15% of GSV Capital is actually invested in Twitter. But nonetheless, we think the transaction will be important to give investors a read on the strength of the overall tech sector going into the end of the year.
We've got a little Twitter news coming up in just a second, but let me get any disclosures that you'd like to share with us about the stocks we just mentioned.
Certainly. I own Intel long. I'm also long Yahoo. I also own GSV Capital. I also own Microsoft, and I own Apple as well.
All right, David, thank you very much. We appreciate your being with us tonight.
Thank you.
And as promised, a little Twitter news here. David just mentioned Twitter has now chosen an exchange to list on. According to a filing, the social media giant plans to list its shares on the New York Stock Exchange, not the NASDAQ, and the ticker symbol will be TWTR. You can figure out how they figured that one out, right, Susie?
Really smart, Tyler. We begin Market Focus tonight with more earnings, and we start with results from the world's biggest beverage maker. We're talking, of course, of Coca-Cola. The company posted numbers in line with analyst estimates as it sold more of its namesake soft drinks, but also teas and waters, especially in countries like China, India, and Russia. And that helped offset the cost of restructuring its bottling operations in Brazil and the Philippines, and an economic slowdown in Mexico. But Coke shares fell almost 1% today to $37.66. Johnson & Johnson, another Dow component, reported better than expected quarterly results, and that's thanks to strong growth for prescription drugs that treat rheumatoid arthritis and prostate cancer. That helped offset weaker numbers from its medical device and consumer products units. The stock rose fractionally to almost $90 a share. A different story for Citigroup. It missed Wall Street's earning estimates. The bank was hurt by a double-digit drop in bond trading activity, which usually slows down in the third quarter. But this time, the results were exacerbated when the Federal Reserve decided in September not to taper its bond buying program. Citi stock finished the day down by 1.5% to $48.86.
Charles Schwab reporting better than expected earnings and issuing a strong outlook. The retail brokerage expects revenue to rise 3 to 5% faster than expenses in 2014, adding that if the economy continues to recover and client trading remains at current levels, it will become even more profitable. The stock up more than 4% to $23.03, and that was good for a multi-year high. Domino's Pizza, the second largest U.S. pizza chain, reported its first earnings miss in more than a year. The reason? Increased spending on overseas outlets and on mobile apps. But it wasn't all bad. Sales rose more than expected in the U.S., helped by new menu items, but that was not enough for investors. The stock fell almost 6% to $64.90. And a non-earnings story to tell you about. FedEx plans to add up to $32 million to an existing stock buyback program. The package delivery company says its strong balance sheet gives it the flexibility to do the buybacks, and it reaffirms its confidence in the company's strategy. Investors seem to like that idea, sending the stock up 4% on this down day to $120.08.
Well, we're now 2 weeks into the rollout of the state and federal online health insurance plan exchanges, and it's been anything but smooth. Bertha Coombs takes a look now at how those internet marketplaces have fared so far and how much still needs to be done.
Stephanie Gordon has been anxious to shop for insurance on New York's exchange.
And I'd really like to have health insurance. I just can't afford it.
But so far, she has not been able to get past the application process.
And then I go to eligibility, and there's nothing. I work in online media, so I know that nothing's perfect. I know that there's going to be glitches, but it's been it's been a couple weeks now.
Like the federal exchange, New York State of Health makes users complete an application before they can shop for plans. So far, 100,000 applicants have made it through the process, but the state is still working out glitches.
We've identified some places in the application where consumers were just waiting simply a little bit too long to be able to get information.
Kentucky and Connecticut are among the states that have had a much smoother open enrollment launch, with exchanges that were designed to let users shop before formally registering, putting less stress on the system.
And we tried to rely on what the customers in Connecticut told us they preferred. They wanted to be able to go on the site and shop and look and see what the applicable subsidies might be.
The state-built exchanges also had the advantage of more streamlined management. The federal exchange, which was built to serve 36 states that opted out of building their own insurance marketplaces, involved coordinating multiple IT companies. Most states went with a single vendor.
You have more of a seamless experience. You're only dealing with one team, one set of protocols. There's not as much of the bureaucracy.
Stephanie Gordon is hoping New York works out its glitches soon, but she'll keep trying to enroll for as long as it takes.
I've been without health insurance for about 2.5 years now, so what's another couple months?
Bertha Coombs for Nightly Business Report.
Still ahead, could a new high-profile hire at Apple signal a major shift in the company's strategy and a hint at new products in the pipeline? First, though, how commodities, treasuries, and currencies perform today.
Apple may be headed in a new direction. It's hiring Angela Ahrens. She's chief executive of luxury British clothing giant Burberry. She'll head up Apple's retail and online operations. John Fort takes a look at Apple's newest hire and the timing of the move.
It's been a tough role to fill. Retail chief for what's arguably the top brand in the world. But Apple CEO Tim Cook has filled the job with a powerhouse, Angela Ahrens, the current CEO of Burberry, who will join the tech giant to lead its $19 billion retail operation in the spring. During her 7 years at the helm of Burberry, Ahrens was known for giving the creative shop more autonomy, cutting costs where needed early in the downturn, and pushing a digital agenda that has boosted the brand's image among high-end customers.
So we invested heavily in technology. We call it retail theater. So all of those big screens, that content is streamed from London. We can stream our shows into our stores. And 180 stores have iPads, so that if what's in the store, the customer wants something else they've seen online, again, not a problem.
Retail is a tough business. Apple's first retail chief, Ron Johnson, left the company 2.5 years ago for JCPenney, where the board forced him out in April. The second chief, John Browett, from UK tech retailer Dixons, lasted less than 12 months. Arendts will have to dive right in.
So she understands the consumer at a level that's extraordinary. And she knows how to talk to her with a high-end product, but build volume out of that high-end product. Very few people know how to do that.
Those skills come at a pivotal time for Apple. When Arendts starts, Apple probably will be gearing up for the launch of yet another iPhone and perhaps a new watch or TV.
Fantastic. Good to see you. Fantastic.
CEO Tim Cook has talked about the stores as the main chance customers get to interact with the brand, which is why he popped in on the iPhone launch day last month. It remains to be seen how core a player Arendts will be in Apple's infamously secretive culture. Will she weigh in on wearable prototypes, new TVs? If so, she could be a major strategic player in Apple's future. For Nightly Business Report, I'm John Fort.
You think she can make a difference?
I think she can. I think she's a real wizard at branding and merchandising.
We'll see.
We'll see Burberry plaid iPhone covers, right?
That's Nightly Business Report for tonight. I'm Susie Garrett. For more on the stories that we cover tonight, go to our website, nbr.com.
And I'm Tyler Matheson. Thanks for watching. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. Discord in D.C. House Republican leaders say they have a new plan to reopen the government and extend the nation's debt limit, while a bipartisan group in the Senate called off its own negotiations. While the nation waits for a deal, ratings agency Fitch put the United States AAA credit rating under review for a possible downgrade. On Wall Street, optimism faded, stocks plunged, and rates on short-term U.S. Treasury bills spiked higher. The Dow fell 133 points, ending 4 consecutive days of gains. The Nasdaq lost 21, and the S&P down 12 points. And Apple has hired the chief executive of British luxury clothing maker Burberry to be the new head of its retail and online sales. Be sure to tune in to Nightly Business Report right here on your public television station.